In 24 hours, one man is going to sit down at a table in Washington and make a decision that will move the value of every ounce of gold and silver you own. And here is the part that should stop you cold. He has already refused to tell anyone which way he is leaning. Not the public, not the markets, not even on paper his own colleagues. Tomorrow afternoon at 2 o'clock, the Federal Reserve announces its decision on interest rates, and the entire precious metals world is holding its breath, waiting on the judgment of a single individual who just weeks ago was handed a form asking him to write down where he thinks rates are going, and who left that form blank. I am going to explain to you exactly what that blank space means, why it may be the most honest and the most unsettling thing a Federal Reserve chairman has done in years, and what it could do to the metal sitting in your safe by this time tomorrow. Stay with me, because by the end of the next few minutes, you are going to understand this moment better than almost anyone else watching the price tick on their screen. And here is the twist, the part one want to give you right now instead of making you wait, because it changes how you hear everything that follows. The market is currently betting that nothing will happen tomorrow. The odds of an interest rate change at this meeting are priced at only around 1 in 5. In other words, the crowd has already decided this is a non-event, a hold, a shrug, and that precisely is what makes it dangerous. Because when the entire market has convinced itself that nothing will happen, it takes only the smallest surprise, a single hawkish sentence, a shift in tone, a hint about what comes next, to send prices lurching. The biggest moves in this market do not come when everyone expects fireworks. They come when everyone expects silence, and the silence breaks. The setup going into tomorrow is a room full of people who have all leaned the same way, and that is exactly the kind of setup that snaps. But before I go further, I want to know who is in the room with me today. Tell me in the comments where in the world you are watching from, and tell me honestly what you are holding right now. Gold, silver, cash, waiting to see what happens tomorrow. Tell me, because I read these, and the mix of answers going into a Fed decision tells its own story about how nervous or how calm this audience really is. And I promise you I am going to come back to what those answers mean before we are done. So let us start with the basics plainly, because you cannot understand why tomorrow matters without understanding the machine at the center of it. The Federal Reserve is the central bank of the United States, and its single most powerful tool is the interest rate, the price of money itself. When the Fed raises that rate, borrowing becomes more expensive across the entire economy, saving becomes more rewarding, and money broadly becomes harder to get. When it lowers that rate, the opposite happens. Money becomes cheap and plentiful. And this single lever, more than almost anything else, determines the fate of gold and silver for one simple reason that you must understand if you are to understand anything about this market. Gold and silver pay you nothing. They sit in a safe. They earn no interest, no dividend, no yield. So when interest rates are high, holding gold has a cost, because every dollar sitting in metal is a dollar not earning that juicy interest in a bond or a savings account. Economists call this the opportunity cost, and it is the invisible weight that presses down on gold whenever rates rise or are expected to rise. But when rates are low or falling, that weight lifts. Suddenly, the bond paying almost nothing is no better than the metal paying nothing, and gold, freed of its disadvantage, tends to shine. This is the fundamental seesaw of the entire precious metals market. Rate expectations up, gold under pressure. Rate expectations down, gold released. Almost everything else is noise on top of this signals. Now here is why this particular meeting tomorrow is so fraught. For most of this year, gold and silver have been battered, and it has confused a lot of people who own them. Gold sits roughly a quarter below the all-time high it set back in January. Silver has been hit even harder, trading around half of its own January peak. And the reason is exactly the seesaw I just described. Through this year, a series of forces have pushed rate expectations upward, and that rising expectation has pressed down on the metals like a hand on a spring. A conflict in the Middle East sent oil prices surging, and higher oil feeds inflation. And higher inflation makes the Fed more likely to keep rates high or push them higher, which is poison for gold in the short term. So the metal you may own has been sitting under this weight for months, and tomorrow the man who controls that weight steps up to speak. If you are finding this useful already, take a moment to like this video and subscribe, because now I need to tell you about the man himself and about the blank space he left on that form, because it is the single most revealing detail in this entire story, and almost nobody is talking about it. The chairman of the Federal Reserve right now is a man known throughout his career as a hawk, which in the language of central banking means someone deeply worried about inflation, someone inclined to keep rates high to keep prices under control, someone who has said plainly that he has no tolerance for inflation and that it remains too high. That reputation alone has been part of what has weighed on gold this year, because a hawkish chairman means the market expects rates to stay higher for longer. But here is where it becomes fascinating, and here is where that blank form comes in. A few weeks ago, at the previous meeting, every member of the committee was asked to do something they do routinely. They were each asked to write down privately and anonymously where they personally believe interest rates will be by the end of the year. These projections are collected and published as a chart, a scatter of dots, one for each member, so the world can see roughly where the institution's collective head is pointing. It is one of the most closely watched signals in all of finance. And when that chart was published, something was missing. The chairman himself, the single most important voice in the room, the man whose opinion matters more than all the others combined, had declined to submit his own dot. He left it blank. He chose deliberately to withhold his own projection from the very chart designed to reveal it. Now, what does that mean? Some read it as arrogance. Some read it as a man refusing to be pinned down. But I want to offer you a different reading, one I think is closer to the truth and far more important for you. I think that blank space is an admission of genuine uncertainty. For years, the Federal Reserve operated by telling the market in advance what it intended to do, guiding expectations, making promises, smoothing the path. A blank dot from the chairman is a quiet signal that this era of confident guidance may be ending, that even the man at the very top is no longer certain enough to commit to a number. And when the person steering the ship stops telling you where he is going, every passenger on that ship has to start thinking harder about the storms ahead. The blank dot is not just a missing data point. It is a message, and the message is that the future is genuinely, honestly unknown even to the people in charge. Let me make this real with two people, because these forces only matter when you see how they land in an actual life. Neither of these people is real, but both are the kind of person you might recognize perhaps in the mirror. The first I will call Walter, 69, retired, and Walter has spent this entire year watching the price of his gold fall and reacting to every single Fed headline as if it were a fire alarm. Every hawkish comment sent him into a panic, wondering if he should sell. Every rumor of a rate hike had him refreshing the price on his phone at midnight. Walter has been living and dying by the short-term seesaw, letting a decision made by one man in Washington dictate his peace of mind. And every time he reacted, he tended to react at exactly the wrong moment, selling in fear near the lows and hesitating to act near the calm. Walter has confused the daily weather with the climate, and it has cost him not just money but sleep. The second person I will call Frances, 66, and Frances is not richer than Walter, and she is not smarter about markets. She simply understands one thing he does not. She understands the difference between the reason she owns gold and the noise that moves its price day to day. Frances knows that the Fed decision tomorrow will move the price perhaps sharply in one direction or another. But she also knows that the reason she holds a bit of gold in the first place as protection against a world of enormous debt and uncertain money does not change based on one afternoon's announcement. So while Walter will be white-knuckled tomorrow at 2 o'clock, Frances will glance at the news, note what happened, and go about her day, because she owns her metal for reasons that operate on a scale of years, not hours. The difference between them is not knowledge of economics. It is the discipline to know which time scale they are actually playing on. Now, why is it so hard to be like Francis and so easy to be like Walter? The answer is not weakness, it is biology, and understanding it is genuinely one of the most useful things I can give you today. When you own something and you watch its price fall, or you brace for a decision that might make it fall, the part of your brain that processes physical threat, the same ancient machinery that once helped your ancestors flee predators, activates before the rational thinking part of your brain has a chance to weigh in. A looming Fed decision does not register in your body as an abstract policy event. It registers as danger, and your body floods with the chemistry of stress, which screams a single instruction: do something, protect yourself, act now. This is why so many people make their worst decisions in exactly these moments of anticipation, because they are not really deciding. They are reacting, driven by machinery superbly designed for escaping lions and catastrophically ill-suited for holding a long-term position through a noisy afternoon. The investors who thrive are not the ones without fear. They are the ones who have learned to recognize that surge of urgency for what it is, a biological reflex, and to sit still while it passes. Now let me be honest with you, and careful, because I will not insult you with fear, and this subject attracts people who want to frighten you into acting. I cannot tell you what the Fed will do tomorrow, and neither can anyone else, including the loudest voices promising certainty. The most likely outcome, by the market's own reckoning, is that rates are held steady and the real action is in the tone, in the hints about what comes later. It is entirely possible that tomorrow passes with barely a ripple, that gold and silver move a percent or two and settle, and that the people predicting a dramatic crash or a dramatic surge are both proven wrong. Anyone who tells you they know exactly what happens tomorrow at 2 o'clock is guessing and dressing the guess as knowledge, and they deserve your suspicion. What I am giving you is not a prediction. It is an understanding of the machinery so that whatever happens, you can read it instead of react to it. Let me widen the lens, because there is a second act to tomorrow that almost nobody is watching, and it may matter more than the decision itself. The Fed announces at 2 in the afternoon, but the truly important number of this week does not arrive until later, when the government releases its preferred measure of inflation, a figure that will tell the Fed and tell you whether the pressure that has been weighing on gold all year is finally easing or getting worse. The decision tomorrow is the loud event, the one everyone will be staring at. But the inflation number that follows is the quiet one, the one that actually shapes what the Fed does next and next and next. The crowd, as it always does, will be looking at the loud thing. The people who understand this market will be watching the quiet one. Remember that, because it is a pattern that repeats endlessly. The headline everyone watches is rarely the number that matters most. And here is the piece that puts all of this short-term drama in its proper place, the piece I most want you to carry away. While ordinary investors have spent this year panicking over each Fed headline, watching gold fall and selling in fear, the largest and most sophisticated buyers on the planet, the central banks of entire nations, have been doing the exact opposite. They have been buying gold steadily, quarter after quarter, at a pace not seen in generations. A recent survey of these institutions found that an overwhelming majority, the highest share in the history of the survey, expect to keep increasing their gold reserves in the year ahead. Think about what that means. The most informed money in the world, the institutions with more data and more expertise than any of us, is calmly accumulating the very metal that ordinary investors have been dumping in fear over Fed meetings. They are not watching tomorrow's announcement the way Walter is. They are buying for reasons that operate across decades, reasons rooted in the structure of a world drowning in debt, and they are using the fear-driven price weakness as an opportunity to acquire more. When you feel the urge to panic over tomorrow, remember who is quietly on the other side of that trade, buying what the frightened are selling, and ask yourself the simple question that follows from it. If the most informed institutions on earth are using this fear-driven weakness as a chance to accumulate, what exactly do they understand about tomorrow and about the years after it that the panicking crowd does not? There is history here too, and it is worth knowing because it shows how this can play out over time. Go back to the 1970s, a decade of high inflation and a Federal Reserve struggling to control it. Through that period, gold did not move in a straight line. It lurched, it corrected, it frightened people out of their positions again and again, and yet across the full decade it rose from around $35 an ounce to over $800, an extraordinary climb, precisely because the underlying problem, a loss of confidence in paper money, never went away, no matter how many individual Fed meetings came and went. The lesson is not that history will repeat exactly, because it never does. The lesson is that the daily noise of central bank decisions, terrifying as each one feels in the moment, is very often just static, laid over a much deeper and slower signal. The people who heard only the static sold and regretted it. The people who understood the signal held on. Let me give you something practical then, a way to actually read tomorrow instead of just bracing for it, because there is a real skill here and almost nobody explains it. When the decision is announced at 2 o'clock and the chairman speaks shortly after, the rate number itself is only half the story. The other half, the half that often moves gold more, is the language. Listen for the tone. If the message leans hawkish, stressing that inflation remains too high, that the job is not done, that the Fed stands ready to do more, then the market hears higher for longer, rate expectations firm up, and gold tends to feel that familiar downward weight. But if the tone softens even slightly, if there is an acknowledgement that the economy is cooling, a hint that the next move might be a cut rather than a hike, a note of concern about jobs rather than only prices, then the market hears relief coming, rate expectations ease, and the weight begins to lift off gold. The same held rate can send gold up or down depending entirely on which of these two songs the chairman sings. So do not just watch whether they hold or move, watch the words that follow, because that is where the real signal lives, and now you know how to hear it. And remember the blank dot as you listen, because a chairman who would not commit to his own projection is a chairman whose words tomorrow will be parsed for every flicker of direction by a market desperate for the guidance he has so far declined to give. So let us pull it all together and go back to that man sitting down at the table tomorrow. In 24 hours, the Federal Reserve announces its decision, and the entire metals market is waiting on the judgment of a single chairman known as a hawk, a man who recently left his own projection blank, a quiet admission that even he is uncertain about the path ahead. The market has priced this meeting as a near certain hold, which is exactly the kind of complacency that makes any surprise dangerous. Gold and silver, already beaten down all year by rising rate expectations and an oil-driven inflation scare, sit coiled, waiting to see whether tomorrow's tone leans harder into that pressure or begins to release it. And the truly decisive number, the inflation figure, arrives quietly after the loud announcement, watched by the few who understand that the headline is rarely the thing that matters most. Meanwhile, far from the panic, the central banks of the world keep buying calmly for reasons that make a single afternoon's announcement almost irrelevant. So here is what I want you to carry away, framed as plainly as I know how. Tomorrow will move the price, perhaps sharply, and there is nothing you or I can do to know in advance which way. But the price moving is not the same as the reason for owning changing. If you hold gold and silver as protection against a world of staggering debt and uncertain money, then a single Fed meeting, however loud, does not alter that reason. This does not mean you should ignore what happens, and it does not mean you should pour your savings into metal in a panic before 2 o'clock tomorrow, because volatility is real and stability matters, especially in retirement. It means you should decide right now before the announcement which timescale you are actually playing on, so that when the noise hits tomorrow, you are Francis and not Walter. The right decision depends entirely on your own circumstances, and I am not here to tell you what it is, only to make sure you meet tomorrow with understanding instead of fear. Do not let anyone use tomorrow's decision to stampede you into a rushed move or a costly product, because they will try and they will grow louder as 2 o'clock approaches. And equally, do not let the fear of a falling price blind you to what the most sophisticated institutions in the world are quietly doing on the other side of that fear. Those are different errors, and the truth sits calmly between them. None of this is financial advice. And every fact I have cited, the timing of the decision, the odds of a hold, the blank dot, the central bank buying, is in the pinned comment so you can verify every word of it yourself rather than take mine. I open by telling you that in 24 hours, one man would decide what your gold is worth, and that he had refused to say which way he was leaning. Now you understand what that blank space means, and why the crowd's certainty that nothing will happen is exactly what makes tomorrow worth watching. So let me leave you with the question underneath all of it. When the man steering the ship stops telling you where he is going, do you panic at every wave like Walter, or do you understand why you boarded in the first place like Francis? The answer costs nothing to decide today, and it may be worth a great deal to have decided before 2 o'clock tomorrow.